This video has been brought to you by the Committee on Public and Government Financial Management on Municipal Bonds for an Atmanirbhar Urban India. We welcome you all to this short video in which we will be covering what municipal bonds are, regulatory framework for municipal bond market in India, role of municipal bonds in making municipal bodies Atmanirbhar or self-sufficient, key provisions of SEBI regulations, why investors should invest in municipal bonds, challenges in municipal bond market, ways to promote municipal bonds, ICAI guidance on issue of municipal bonds, and how ICAI members can support in municipal bonds issuance. Let us begin by understanding what municipal bonds are. The fund requirements of municipal bodies in India is increasing day by day due to increasing urban population and rapid urbanization. Grants and existing sources of funds available to municipal bodies are not sufficient. Apart from own source revenue, municipal bodies need to explore alternate sources of funding, prime amongst them being the capital market. The capital market is the least explored area from where municipal bodies can raise funds by issuing municipal bonds. The tenure of municipal bonds is generally long, that is 10 to 20 years, so the municipal bodies have a better option to raise funds for long-term projects that require large amounts of funds. Example, to finance development of large and capital-intensive projects with long gestation periods such as construction of highways, bridges, or schools, or any other project of public utility such as water conservation and harvesting projects, energy saving or green energy projects, etc. Municipal bonds are debt securities issued by municipal body that creates an obligation on the municipal bodies and entitles the investors to interest at specified rate plus repayment of principal as per specified payment schedule. Municipal bonds can be classified into two types: general obligation bonds and revenue bonds. General obligation bonds are used for general infrastructural needs and are repaid from the general government funds or taxes like property taxes. Revenue bonds are used to finance specific projects, and these are repaid through the revenues or taxes generated from those specific projects. All the municipal bonds that have been issued so far as per the SEBI regulations are general obligation bonds, as they have been secured by either property taxes or a mix of municipal taxes that include property taxes. In India, Securities and Exchange Board of India (SEBI) is a regulatory authority for all kinds of equity and debt securities, including municipal bonds. SEBI issued regulations for issue and listing of municipal debt securities in 2015 that were amended in 2019. Municipal bodies in India are governed by the municipal acts enacted in respective states. First and foremost, the acts governing the municipal bodies must permit borrowing through municipal bond securities. SEBI regulations cover eligibility and conditions, requirements for public issue or private placements, conditions for continuous listing and trading, obligations of intermediaries and issuers, procedure in case of violation of regulations, and some miscellaneous provisions. SEBI regulations also cover other important aspects like credit rating, minimum subscription, accounting, auditing and reporting requirements, forms, and other disclosures. SEBI also issues guidelines and circulars for clarifying procedures in respect of different aspects of municipal bond issue from time to time. ICAI also issued a publication on municipal bonds for financing urban infrastructure in India, an overview revised edition issued in September 2020 to make stakeholders understand various aspects relating to municipal bond issuance, including the challenges faced by the municipalities while issuing the same. The municipal bonds are playing an important role in making municipal bodies Atmanirbhar. The process involves external verification by credit rating agencies. Therefore, a well-run municipal body can raise funds through municipal bonds easily. Such bonds indirectly help in making known amongst public, investing or otherwise, that the governance is better at that municipal body, hence enhancing transparency and accountability in operations of the entity. Municipal bonds ensure implementation of reform initiatives such as municipal bodies have to mandatorily implement accrual accounting system before approaching market according to SEBI regulations. SEBI regulations directly or indirectly help in improving financial reporting and operational efficiency of municipal bodies, and also in planning and implementation of capital-intensive projects in better manner, as SEBI regulations also focus on utilization of issue proceeds of municipal bonds for specific projects only. Now, let us understand the key provisions of SEBI Issue and Listing of Debt Securities by Municipalities Amendments Regulation 2019. As per SEBI regulations, the issuer of municipal debt securities can be any municipality or any statutory body or any structure set up under the Pooled Finance Development Fund scheme of the Government of India, or any special purpose vehicle notified by the state government or central government, subject to the condition that it undertakes one or more functions that are entrusted under Article 243W of the Constitution of India. Issuer shall be eligible to raise money by its governing law. Issuer shall obtain in principle approval from one or more recognized stock exchanges for listing. No order or direction of restraint, prohibition, or debarment by the SEBI is in force against the issuer or its promoters or its directors from accessing the securities market. Issuer shall prepare its accounts in accordance with the National Municipal Accounts Manual (NMAM) or State Municipal Accounts Manual that are based upon NMAM or the accounting standards as applicable to them. Issuer shall have surplus income as per its income and expenditure statement in any of the immediately preceding 3 financial years. However, if the issuer is a body corporate, then it should not have any negative net worth in any of the immediately preceding 3 financial years. Issuer shall not have defaulted in debt repayment during the preceding 365 days. The municipal bonds can be issued by the issuer by way of public issue or through private placement to a selected group of not more than 200 persons in a financial year. In case of public issue, minimum subscription limit shall not be less than 75% of the issue size. In case of private placement, offer is to be made to not more than 200 persons, with each subscribing to minimum of Rs 10 lakhs. Issuer shall obtain credit rating from at least one SEBI registered credit rating agency. As per market preference, AA and above is the preferred investment grade credit rating. Issuer shall appoint merchant banker and a SEBI registered debenture trustee for the issue. A trust deed shall be executed in the favor of the debenture trustee for securing the issue of municipal debt securities. Issuer shall create a separate escrow account for servicing of municipal bonds with earmarked revenue. Issuer shall utilize issue proceeds for specified project only. Issuer shall make disclosure of all material facts in the offer document in case of public issue, or in the placement memorandum in case of private placement as specified or prescribed, and file the offer document or the placement memorandum, as the case may be, with SEBI and the designated stock exchange. The issuer, its promoter, or directors should not have been named willful defaulters and fugitive economic offenders. Now, we will be covering other important aspects regarding municipal bonds market. SEBI constituted a Municipal Bonds Development Committee in 2020 headed by the Executive Director of SEBI, comprising of representatives from Ministry, municipal corporations, lawyers, professionals, and market practitioners as members to make recommendation to SEBI on policy matters pertaining to development of municipal debt securities market. SEBI introduced information database and repository on municipal bonds in 2023. This database contains a wide range of information in the form of statistics and regulations, circulars, guidance notes, and frequently asked questions issued by SEBI in respect of municipal debt securities. The repository contains various checklists for pre-listing requirements and sample letters or certificates, templates for agreements between various stakeholders. Issuer has to deduct TDS at concessional rate of 5% under Section 194 LD of the Income Tax Act 1961 while making payments to any investor, including qualified foreign investor. Central government is trying to promote municipal bonds by introducing Pooled Finance Development Fund scheme. Under this scheme, several municipal bodies can come together to raise funds by jointly issuing bonds either publicly in the open market or through private placement. Apart from this, the National Stock Exchange has launched India's first municipal bond index, that is Nifty India Municipal Bond Index, that includes portfolio of municipal bonds issued by municipal corporations having investment grade credit rating. The Ministry of Housing and Urban Affairs, Government of India has also introduced an incentive scheme called Interest Subvention under the Mission Amrit, that is, Atal Mission for Rejuvenation and Urban Transformation from 2018-19 onwards, and Amrit 2.0, wherein the financial incentive is provided to the ULBs claiming incentive for the first time amounting to Rs 13 crore per Rs 100 crores worth of bonds issued with the total incentive not exceeding Rs 26 crores per ULB. ULB can claim incentive for the second time against fresh issuance of bonds if the bonds issued fulfill the criteria of green bonds specified by SEBI. On issuance of these bonds, ULBs shall be eligible for an incentive of Rs 10 crores per Rs 100 crore worth of bonds issued with a total incentive not exceeding Rs 20 crores. Incentives will be awarded on first come first served basis. An ULB can claim incentive immediately after issuance of bonds with supporting documents. This list provides details of municipal corporations that have raised funds through issuance of municipal bonds. Now, let us look at why investors should invest in municipal bonds. The positive points that attract investment in municipal bonds are: municipal bonds are sovereign instruments and hence are considered more credible and safe investment option. Municipal bonds are backed by sovereign guarantees and hence reduced risk. The negative points that discourage investment in municipal bonds are: municipal bonds offer fixed interest that is comparatively lower than other market instruments. Municipal bonds are generally of long-term maturity periods that affects investors' liquidity. Investors' dilemma while making these decisions of investment in municipal bonds are: non-availability of updated financial information of municipal bodies. Only few municipal bodies manage to obtain high credit rating due to their operational issues, and frequent changes in management due to transfer of officials in municipal bodies affect stability of the organization. Further, the challenges in issuance of municipal bonds are: municipal bodies' dependence on central and state governments for grants is increasing due to their inability to generate own funds. Frequent transfers in municipal bodies affect management stability. High transaction cost involved in accessing the capital market that consists of management fees, royalty fees, and underwriters' expenses, etc. Generally, investor-friendly accounting records are not kept by the municipal bodies in India. There is also absence of reliable disclosures by municipal bodies. There is lack of transparency in disclosures of planning and implementation of projects, which reduces creditworthiness of the municipal bodies. Municipal bodies' own source revenues are quite less, so the maintenance of healthy credit ratings, which is a qualifying criteria for bond issuance, is something that many municipalities are incapable of. Another concern is adequacy of revenues for repayment. Property taxes, which are the primary source of own source income of ULBs, are usually very low. Smaller municipalities often find it difficult to access the capital market due to lack of capacity and scale. There are several ways to promote municipal bonds, including the following. Municipal corporations need to be incentivized by the government by various means such as offering subsidies, low transaction costs, etc. Government can also consider categorizing municipal bonds as priority sector for the purpose of investment, pension fund, insurance fund, provident fund, and relevant foundations or trusts may be encouraged to necessarily invest in these bonds by expanding the range of approved investments. Investment in these bonds may also be made admissible for statutory liquidity ratio investments by banks. Success of municipal bonds totally depends on how quickly we reform our municipalities in terms of governance, transparency, information disclosure, and improved efficiency. Accordingly, the reforms and improvement in the area of accounting and audit mechanism require the attention of urban administrators. Review of the existing relevant acts and guidelines in this regard must be undertaken. Capacity building of staff of municipal bodies on implementing accounting and financial management reforms must also be organized on priority. Now, let us go through some of the recent initiatives in this area. Green bond is a new concept. India's first sovereign green bonds framework was approved recently. Green bonds are debt securities designated to finance environment-friendly projects. Most urban infrastructure bonds may be categorized as green bonds given that their proceeds are predominantly targeted towards energy, transport, water management, sewage treatment, energy saving, and so on. Indore Municipal Corporation has listed its green bonds of Rs 250 crores on the National Stock Exchange to contribute towards India's vision for transition towards a clean and green energy future. The said public issue got an overwhelming response with an overall subscription of 5.91 times of the issue size. This slide carries an overview of relevant points of Union Budget 2023-24 about Urban Infrastructure Development Fund (UIDF) and municipal bonds. For urban transformation, Rs 10,000 crores have been set aside to set up UIDF to develop and finance urban infrastructure projects. The purpose of setting up UIDF is to encourage states to undertake urban planning reforms and actions to transform cities into sustainable cities of tomorrow. This fund is expected to help urban local bodies to improve their finances and create urban infrastructure in Tier 2 and Tier 3 cities. Also, as mentioned in the Budget 2023-24, property tax governance reforms and ring-fencing user charges on urban infrastructure are expected to provide requisite incentives to cities to improve their creditworthiness for municipal bonds. Also, states will be encouraged to leverage resources from the grants of the 15th Finance Commission as well as existing schemes to adopt appropriate user charges while accessing the UIDF. Guidance from ICAI is also available for issuing municipal bonds. ICAI issued a publication on municipal bonds that explains the concept of municipal bonds, relevant updated SEBI regulations, municipal bond market in India, international perspective, and how chartered accountants can support municipal bodies in tapping the capital market and issue municipal bonds. ICAI has also extended proposals to municipalities to support them in the issuance of municipal bonds by aiding them in implementing accrual accounting system that is an essential precondition for accessing capital markets as per SEBI regulations, imparting knowledge on municipal bonds by organizing trainings on accrual accounting and relevant SEBI regulations, review and revision of municipal acts and manuals for smooth adoption of accrual accounting that is an essential condition for issuing municipal bonds. Chartered accountants can play an important role in matters relating to the issue of municipal bonds based on their multifaceted knowledge. CA can support the municipalities in preparation of financial statements, in implementation of accrual accounting in municipalities if it is yet to be implemented there. Municipalities officials and employees require training for implementing accounting reforms which are mandatory for bond issue. Chartered accountants can impart trainings in this regard apart from other general financial, organizational, and managerial topics. CAs can also support to ensure continued compliance such as timely preparation of accounts as per accrual accounting, audit and publication of financials, half-yearly reports, etc. CA can handhold the municipal body in analysis of their financials, supporting them in various steps involved in the bond issue, creating body corporates under Companies Act 2013 if the municipalities propose to create so. CAs can also support in necessary certification that is required in relation to the bond issue. Example, certification of utilization of issue proceeds for execution of the projects, etc. and advising local bodies with regards to various statutory compliances as per relevant regulations and guidelines. There is a requirement of audit by CAs of escrow account and project accounts as per relevant regulations or guidelines. Pune is the first city in the country that issued municipal bonds during 2017 for its 24/7 water project since the issuance of SEBI regulations. Let's have a look at Pune's municipal bonds issuance process. Other cities may refer the same and adopt it for issuance of the municipal bonds considering the state-specific requirements. This brings us to the end of the video. Thank you.